hit on such an important point is I just want to get through this because I've got a book, I've got positions on, I want to manage them, and I want to take this randomness out. Now, that is one way we can look at it. Now, another, as self-directed traders, especially trading futures, which are really binary outcomes. You're short, the market goes down, you win. If you're long and the market goes down, you lose. It's a very straightforward thing. So FOMC meetings, just to let you know, they always come out at the same time, 1:00 Central Time, 2:00 Eastern Time. And what comes out is a very short, either page or two press release, so that you get this press release that basically gives them a summary of this meeting they've been having today or tomorrow morning for the day. And it gives some insight into what the 12 Fed governors, and there are 12 Federal Reserve districts. And this actually was developed it was the basic mechanism for clearing checks. Checks went to the Fed and were cleared and sent to the appropriate bank that they were written on. And that's the way the adjustments were weighed. The 12 districts exist still now, but really they act as a collective group. So there are 12 Fed members and then a chairman. This release is the cumulative kind of summary of these 12 Fed governors. Now, this is a binary event. What I mean by that is you get this announcement at 1:00 and the markets will jump all over. And it's so funny. There are algorithms that do nothing but look at this statement, compare it to last. And if they change three words, they're going to buy or sell on that. And for a 5-second trade, which is not what we do, sure, maybe that works. It's interesting how people apart. But the second part of the binary event, at 1:30, the chairman of the Fed will sit down and have a press conference. Now, what does he do that's different than the release of the meeting? Well, actually, they'll use it as a tool that if the market doesn't quite react as they want it to from the statement, he'll use that press conference to kind of walk back, a little bit of what the market may be, as they will say, misperceived what he meant. So we've got this 1:00 statement, the 1:30 press conference where the chairman will take and give questions. And honestly, this is the back and forth. So there is, you really have to kind of set yourself up for two separate events, the presser that comes out and then the press conference afterwards. And John, if we can jump ahead a slide. So
and I think the best thing you just said was the idea of the conference. I mean, it's mostly been about that ever since, like you said, we had the big cut, 100 basis points. I think it was March of 2020. I remember I was at a conference when it came out. I showed my boss at the time. He was like, "What?" And then he went and showed somebody else. But mostly it's been about the rhetoric, right? Over the past however many meetings, it's been about the rhetoric that Powell is going to say, and so I'm pretty sure that's what we're going to be looking forward to again, because I feel like we're in this interesting spot right now, really close. We're kind of at some inflation, obviously, and we're really close on that point as far as how high inflation. Right. But we're not too far, I don't think, from a potential recession if we were to just yank the cord and start ranking rates. Who knows, right?
Well, and you know what? That's exactly what I think that's what makes this so different, this zero rate environment. We look at a 2-year yield here, and that isn't 1.7%. That's 17 basis points, which is so near zero. It's truly absolutely amazing. So this 2-year S2Y is probably the closest reflection of what the Fed does, because we see that the 10-year rate is closer to 150 basis points or 1.5%. And the 30-year rate is a little over 2%. So the 2-year here, the shorter duration is, remember, the Fed controls that short rate. This is the shorter duration that probably is most affected by them. But, what you said was so spot on. It's what the perception is. Now, the Fed currently is buying $120 billion of securities every month. So the Treasury sells debt to fund this great deficit we have, and the Fed goes in there and buys it. So you'd almost think like, well, what in the world are they doing? Well, they're trying to control the rate of ascent of interest rates when all this debt is flooding the market. So what will be parsed through is a little bit of, will they continue to buy debt? Will they continue to support the market in different ways, like in the short-term funding market? So each one of these segments will be looked at. The 120 billion a month number will be parsed. And if that changes, that's an indication that the Fed may be slowing down and going to, I don't know what normal is anymore, Jamal. I don't think any of us know what normal is. So,
either. But you're right. That's what everybody is kind of waiting on. And right. I was talking with Josh about this yesterday about sometimes I hate financial media because a couple of people write something and then all of a sudden it becomes, just law. Like they're talking about the idea of, at some point, maybe around Jackson Hole time, which is late August,
right,
we're going to start saying we're going to taper, meaning, like you said, us not doing as much buying of treasuries and or mortgage-backed securities. We don't know when that's going to happen, but it's like that's what everybody starts talking about. Next, trades start reflecting that, and we'll see what happens. But that is the idea, right? Like I think the general idea, people believe at some point we're going to taper, which again means they're not going to be buying as much treasuries and mortgage-backed securities, and then maybe somewhere down the line raise interest rates, right?
Absolutely, and it's such a succinct summary of that's the thinking. So if they ease the pace of buying, or actually. And they've been very clear that they're going to ease the pace of buying before they start raising rates. What's actually going to happen to the market? And it's usually not, even if, and I always say that, if somebody handed you that press release 10 minutes before it actually came out, most of the time you couldn't make money using that because the market will not do what that press release says it does. So there is a randomness to this. Now, John, if we jump one slide ahead, we could see here the disconnect between those short-term rates and the medium and longer-term rates. Now, again, where's the Fed involved in this? Well, they don't set these. Again, they just set that overnight rate. They're affecting medium and longer-term rates, as you just said, by going in and buying them, which is very different. We've never seen that before. The Fed actually hold a balance sheet, hold assets. So the question about what they do with these assets is going to be very interesting. Now, last time, they did this and everyone thought, okay, they're going to stop buying it and the market will adjust. Well, what the Fed did during the housing crisis was they just held on to them till they matured. They never sold them. They can do that. They can just hold them forever. There's no requirement. They live in a very different world. They can just hold these things forever. And so this selling that everyone's looking for can never take place. So we look at the opportunity around movement here. We know that first mover wise, where would you be looking? Are we using the same order as we're using with the unemployment number in terms of, I think the first mover is going to be rates, and you and I probably agree on that. Where else are you going to focus?
For this one, I mean, gun to the head. I mean, the dollar, that's probably the other place. But like we said, I just wonder how much movement is going to happen. I mean, right. But yeah, those are the two places that I'm going to look for sure tomorrow. I mean, especially considering yesterday we had a 3% move up in this 10-year yield, right? I mean, it's a big move.
Yeah, it certainly was. And you know what? It's funny because I think a lot of people have said, well, I'm going to watch equities. I mean, I'm going to watch rates because it's a rate announcement. Now, remember, it's a very different part of what we trade in terms of which particular rate. We don't trade an overnight rate or even a 30-day rate. And then they might say equities, but I agree with you. From my experience, the most interesting first mover parts will be the 10-year, the 30-year, the 2-year, and currencies. Currencies will be what I'm going to focus on most. So it's very interesting aside. You're absolutely right. Will crude get pushed around and pulled around a little bit? Sure. Maybe some gold and silver, a little bit. Those I consider like second and third tier movers. So that's really where I want to probably, like you, keep my focus. I'll be watching those dollar levels. I think you and I are both long some dollars in a little bit better position than we were a couple of weeks ago. Yeah. So, which we always love to see, but watch to see what that reflective, and what you'll see is at 1 o'clock, a reflexive move. And what I mean by that is just a kind of headline driven spike one way or another. And then what is the continuation move or the move we trade where you'll get the back and forth? And that is going to be interesting.